G'day guys, welcome back to the Devon Toogan Investing channel. Today in this video, we're going to be having a look at Dropbox's third quarter 2021 results. So before we get into it, guys, please like this video, subscribe to my channel, and let's waste no time. Let's get into it. So what do we have? Revenue of $550.2 million. This is an increase of 12.9% year over year. But on a constant currency basis, we're looking at growth of 10.7%. Annual recurring revenue, ARR. This ended Q3 at $2.218 billion. We can see this has increased 12% year over year. And also, again, on a constant currency basis, 10.4% growth. In terms of paying users, we can see that this has also increased quite nicely. That looks like, 16.49 million paying users compared to 15.25 million paying users. This is them tapping into their 500 million plus user base. That includes all the free users as well. And we can see the average revenue per user, the ARPU, that's up to $133.79, and this is compared to $128.03 from last year. So very solid growth, that's what I call it. I believe from Q2 to Q3, if I remember correctly from their conference call, they did increase this number here by 350,000 users, I believe. So that's their increase compared to Q2. This shows their year over year increase. GAAP gross margins, that's 79.6%. It's gone up about 1.2% compared to last year. Non-GAAP gross margins, we can see it's up. They already hit their long-term target that are aiming for 2024. They're already at 81%. This is compared to 80%. I'll be looking at this to save between 81%, 80% pretty much from now on. I'm not too sure how much more they're going to be able to squeeze out of this non-GAAP gross margin. In terms of operating margin on the GAAP basis, it's increased quite a lot, like a huge increase year over year. 14% compared to 6.2% from the previous year, and we can see a large increase in non-GAAP operating margin. It's all the way up to 29.3% compared to 23% last year. As a result, we can see this flow through into non-GAAP net income. It was 147.1 million compared to 110 million last year. And then my favorite metric when it comes to Dropbox, free cash flow. We can see they delivered Q3 free cash flow 221.5 million as compared to 187 million last year. And the nice thing about Dropbox as well, you can see that they have just about $2 billion in cash equivalents, and short-term investments. You got to remember this company, they're about $12-13 billion company. I'm fairly sure. And look, they got $2 billion right there on the balance sheet to do whatever with, whether it's buy back shares or create new purchase new acquisitions to make their products better, whatever it happens to be. But guys, I'd say based off these Q3 numbers here, I'm very impressed. They're pretty much executing how I'd expect them to execute. In my opinion, they're ahead of schedule to meet their $1 billion in annual free cash flow by 2024. It looks like they'll probably hit that in 2023. But yeah, if you're a shareholder, which you should be happy. I'm happy. I'm a shareholder. I bought in. I think my average price is about $22 per share, and so far my thesis is playing out. Now, if we jump over to the earnings call transcript, we can see the guidance that management put out for Q4 and the full year. So we can see that for Q4, they're expecting revenue in the range of 556 million to 559 million. This is assuming currency exchange rates for approximately 2 points of growth. They're expecting the non-GAAP operating margin to be approximately 29%. And they're expecting weighted average shares outstanding to be in the range of 391 to 396. So obviously they're planning to buy back some more shares over Q4, and pretty much it just depends what the share price is when they buy those shares. For the full year 2021, they are raising their revenue guidance, which was previously 2.136 billion to 2.142 billion, and they're increasing it to 2.148 billion to 2.131 billion. They're also updating their gross margin guide to approximately 80.5%, which is excellent. That's pretty much where their long-term target is. They're already there. And they're raising their non-GAAP operating margin guidance to 29.5% from the previous range of 28.5 to 29%. Fantastic. This is where they're well ahead of schedule. They're expected to hit these sort of margins, in 2023 or 2024, and the fact that they're hitting it now in 2021, look, you got to be happy with it. You can't be mad with it. Taking into account, okay, so they're expecting their free cash flow to be approximately 715 million, where their previous range was 710 million to 730 million. The reason why it's maybe not a bit higher, like on the high end of the range or even exceeding this range, is because they're taking into account the lease buyout opportunity to get out of some of their capital leases, which should actually, even though it affects free cash flow slightly now, this should lead to more free cash flow in the future. So yeah, it's nothing to be concerned about after all. They've knocked it out the park regardless. So they're maintaining the expectation that weighted average shares outstanding will be in the range of 397 to 402 million shares. That's what is expected. Obviously, they're going to be buying back some more shares, which is nice. That gives us shareholders more total ownership of the company. So with operating margins now expected to grow approximately 8 points and free cash flow expected to improve by more than $200 million year over year, it is important to consider that we don't expect progress of this magnitude every year. And while our growth on profitability this year was outstanding, we are equally focused on driving sustainable revenue growth. Honestly, this makes a lot of sense. If they grew at this sort of rate every year, we would hit their targets way too early, and their targets just wouldn't even make sense. But I think the reason why they can't keep growing this year is because they made a lot of cost savings over this previous year with, shifting from working in offices to, the company employees working at home. This has actually led to a lot of cost savings for Dropbox. They cut a lot of their workforce, which has also led to cost savings. So this is why their margins have expanded, so much over the last year, and this is why their free cash flow in consequence is also, increased at a much faster pace than, let's say, their revenue has grown. So I would expect moving forward, free cash flow to probably grow something closer to what their revenue grows, maybe slightly faster. There's probably still a little bit more free cash flow margin that we can squeeze out of this. But I think most of the growth in free cash flow from this point forward is going to come from increasing the revenue, which obviously, without the massive margin expansion, it's going to take a little bit longer, and it's not going to be quite as aggressive. But it really, like I said, multiple times now, they're well ahead of schedule with their targets, and there's nothing to really be concerned about. Hopefully they would. Well, there's two things I want them to do with the free cash flow. the first thing is going to be buyback shares. That's quite important to me. Us shareholders want to receive, shareholder value out of the cash that Dropbox generates. The second thing I want them to do is reinvest into their own business, acquire new businesses that, makes the products that they have better, maybe more sticky products. We want to see that annual recurring revenue increase, and also the ARPU increase. That ARPU increasing is also how we're going to expand our margins as well over time. But yeah, that's that might be it for this update. Guys, Dropbox, I'd give this like maybe an 8.5 out of 10 earnings. Look, the management is doing exactly what they said they were going to do. So I can't be mad. I think this company is definitely on track to hit their $1 billion in free cash flow by 2024. And if that happens, then they continue buying back shares. Like I think there's still a fair, distance that this stock can run. I can see the stock easily getting between, $50 and $60. Just based on a discounted cash flow model out into 2024. So there is a bit of runway for this stock to appreciate. I feel like not everything is priced in yet. But yeah, guys, make sure you like this video, make sure you subscribe, and I'll see you in the next one.